Hello. Good morning. Is everyone awake? Morning. All right. We have an interesting panel for you, something which all of you might be looking forward to, about funding and money, and how do you get that cash infusion into your company. We have a great set of panelists today. First to my right, we have Charles Sidman, and next we have John Ritchie, and after that we have Barbara Higgins, also actually from F50 Insurance, the Elevate program. I'll let them introduce themselves and talk a little bit, but just to kind of lay the background here, we're going to talk about angel investing and how angel investing trends have happened and what are the changes you would have noticed in years to come. But some of it, but more on, again, what's happening today in angel investing and how it's helping the entrepreneurs, or maybe not helping them. So are angel investors heavenly, or are they hell's angels? So let's take that off, and then so let's start off with a brief introduction, who you are, what you do currently, and how did you get involved in startups and angels?
My name is Barbara Higgins. I'm an accountant and a lawyer and an Olympian. I got involved in startups early on just because somebody talked to me about a good idea, and I thought, I've got the background to be able to help them get started and help them raise some money. And from there, I went into actually being the person that they asked for the money. And now I'm working with F50. F50 also funds early stage companies. We look for really innovative, as you can see from our Elevate program, that those are the type of companies we're looking for.
My name is John Ritchie. I run a group, an angel investor group called US Angels. And I'm also a member of 3 other groups, Carezza Forum, Harvard Business School Alumni Angels, and Bay Angels. How I got involved in angel investing is I sold a company. We sold a company about 15 years ago, and that was my second startup. It was the first time I had to raise money, and I had, at that time we didn't have all these accelerators and incubators and all these events, and I had to scramble to find these mysterious angel investors. So after I sold my company, I started a nonprofit to get entrepreneurs to meet angel investors at breakfast events, and that kind of evolved into a process where we started screening some of these companies. We saw some people invest in some of these companies, and that became US Angels.
Good morning. I'm Charlie Sidman. My background is in discovery and entrepreneurship. I started out in computers and IT, and I did what has become known as AI and robotics long before those terms were in common usage. Then I went to biomedical work. I've been an academic and a professor and a lab rat for many years. During a sabbatical, during the academic period of my life, I met my first angel investor. I didn't know what that was. It was a fascinating interaction. I got involved in that myself, and now for 20 years I've been doing investing, the last 10 full-time. I do it all around the world. I've had enough experience, both successes and battle scars, to have been termed both a super angel and an archangel, but I want to emphasize that angel investing, for me, is people writing checks with their own money. Fund managers write checks with other people's money. It no longer applies to what stage you're participating. Used to be that angel investors got in the first outside money after the friends and family. I don't believe that's the case anymore. So now it's your money or other people's money. And so I participate in entrepreneurial finance with every conceivable mechanism: angel investing, fund management, financial deregulation, Wall Street, public markets, etc. And it's a wonderful field, and I'm happy to be with you today.
All right, sounds like a diverse methods of funding here.
Right.
So let's, angel investing and angel investor groups are becoming very sophisticated in today's capital ecosystem for entrepreneurs. There's more groups, more syndication, larger deals, and all kinds of stuff. So let's, a question to the panelists here. How do you, your group, how do you source deals? How do you fund? And what's your methodology of funding? So let's start off with Charles here.
Okay. Well, because I participate in so many different mechanisms, I have a diverse source of deal flow. So I participate in a number of established groups, coast to coast in this country as well as elsewhere in the world, and they serve as local recipients for a lot of applications. I also am out there all the time, networking like crazy, so I get solicitations and offers directly. And because I still go to scientific and technical events and fields, sometimes I find an opportunity that may not know it's an opportunity yet, but I instigate it. So a wide variety of deal flow options.
So I have a mixed sources. A little bit like Charles, I participate in a lot of these events, so I meet a lot of startups. So some of us participate in a lot of events. Some of our members belong to other groups, and also, you know, kind of go around. So I get a deal flow from my members, I get deal flow from events, and a lot of referrals.
As many of you know, probably that F50 website has access basically to 100,000 people that submit applications or nominations, and that's a really great source. If you find a group you're interested in, go on their website. They usually have, you know, like nominations that you could make, and that really helps from our standpoint.
Actually, Charles, you got a point about looking at deals across the country. Do you have a preference for deals which are local versus how do you look at deals which are not in the local geographic domain, and that actually applies to the other two as well? Do you have any preference? Do you had problems with looking at deals which are not geographically based here in the local area, maybe in the Pacific Pacific coast? Can you guys comment on that?
Yes, I do look at deals and participate in deals all over the world. I am atypical in that sense because most angels prefer local deals. So if I'm not right there, or I can't travel there or play a role, important for me is a trusted colleague who is on the scene. I don't have to be on every board, and I don't have to visit every company meeting, but a colleague that I have confidence in and experience with can be a substitute for that.
So at US Angels, we tend to look at deals from all over the country. Because of the nature of our deal flow, we still end up looking at a lot of California companies. But we've invested in Ohio and Boston and Florida. That is not typical of most angel investor groups. There are 8 or 9, depending on how you're counting, angel investor groups in the valley at large. And, there's probably 2 or 3 out of 9 that may take a look at companies that are not, from Silicon Valley or from Northern California. And this weird dichotomy between Northern California and Southern California and the groups down there, long story. But some groups are really focused on their own backyard, and there's 2 reasons for that. In Northern California, you could say we have so much deal flow locally. Why deal with companies who are based in Georgia, right? That's one reason. The second reason is the old saying, angel investors want to be able to get in that car and drive for an hour and then go beat up on the CEO, which is not really true anymore, but there is a little bit of that thinking.
Yes, from the F50 perspective, we're really looking for how we can make an impact. In the past, obviously, it was relatively local, but this last round, we have a company all the way from Japan, as you heard. So it definitely is a matter of whether we can actually do something to help them locally. And if they're looking for a local connection, that would be what we would be able to provide.
One last thing, there was, I can talk about them because they no longer exist. There was a group led by one of the grandmothers of Silicon Valley. There was a group called Angels Forum, and great people, by the way. Some of them became limited partners in Mighty Capital. Angels Forum used to have this really strict rule that your headquarters had to be within, I think, 25 miles of Palo Alto for you to be able to apply to the group.
That's really funny. I used to know Carol Sands at Angels Forum. So I guess what, in summary, what the panel is saying is, really distance is not a problem anymore, and they are willing to look at good deals across the country as long as they have some kind of a trusted reference or a source who can validate what's going on and be in touch with the company and be able to evaluate the progress and keep it in good books.
I think that's what the three of us are saying, but I don't think we're typical. The average angel group and investor still prefers a local deal.
No, that is the case. I mean, I from Thai Angels, I know what the numbers are, and 8 out of 10 deals are all pretty much in California, excluding Southern California. But it's always been Seattle, Portland, or mostly Silicon Valley and around that area. So,
would you like a comment on why that might be?
I think John nailed it really good. We got so much deal flow right here, and then why look elsewhere? And then the other thing is a lot of it comes from the network, right? It is a lot of referrals. So when things come from ex-entrepreneurs themselves, or it's the same ex-entrepreneur who started another gig, and so you have confidence in that team, and you have confidence in someone who's started the seed for that company. You're not going to go and explore another company for whom you don't have a history with or you don't know much about. So it's, unless it comes referred really well from the East Coast or somewhere else, where you know that person, you know that founder, you know that VC who's referred, it's really hard to get out of the comfort zone.
I could add 2 things to that.
Yes.
This is all true, but I think we should look at what the unique roles or features of angel groups are. And there's 2 things in my mind. One is uniquely, it's a mechanism to involve people with experience, knowledge, monetary resources in the entrepreneurial system. That happens locally. Secondly, angel groups are the best mechanism for meeting, mentoring, working with the starting entrepreneurs, which again happens more locally. If you're just talking about financial investment results, I think the system changes, and looking and operating globally or beyond your local backyard makes sense. But let's be clear, angel groups have some unique contributions to make, and then the financial returns operate by a different set of metrics.
I actually had that as a question, but since you brought it up. So I wanted to talk about the philosophy of why does angeling work, and why do people become angel investors? I think angel investing is all about psychic, these are called psychic angels, i.e. these are ex-entrepreneurs or people who want to give back to the community, and they want to mentor, they want to be part of that process which they themselves went through, and they want to create the same thing with another person, with another community. I mean, I'm not saying that they are not for profit. Of course, they do want returns. I mean, nobody's doing this for charity, but they also want to be involved in a process where they want to mentor, help, be involved in the process, and that's exactly what Charles is talking about, is to be part of the process, to be available as the company makes those steps, hits those obstacles, and help them get over it. Whereas, in the venture community is not as much, because they're strictly looking at a lot of those X returns. Okay, I think in the interest of time, let's move on here.
Actually have one comment about that. I think that when you're looking for an angel investor, the personalities are really, really important. I remember when I was on the other side, where I was looking, I was a startup looking for money. It was critical that when we presented, there was a chemistry there, because we really want to rely on them as a mentor. And if you don't take advantage of that, you're really missing part of the whole angel program. So keep that in mind, definitely.
And one other comment on the comment is, let's not disrespect the venture capitalists and the crowdfunders and the public market. If I'm involved in a company, I will do everything possible to help it succeed, whichever way it's obtained its money.
True. So today, we have a lot of trends changing in angel funding. I mean, it is not uncommon to see large checks being written from angel groups. I mean, we have seen 500Ks to $1 million and even higher. And apart from super angels and high-end angels like your Shark Tanks or whatever, you have your regular community angels, your alma mater angels like MIT angels, Berkeley angels, and there are a lot of angel groups. So sort of like they're very similar to your early stage VCs, VC funds in many cases. So the questions to the panel are like, what are the trends you're seeing in VC and angel investments? I mean, angel investments more. What stages do you like to see? Deal sizes, terms. You can also look at, do you see co-investing with VCs as a condition? Any preference to price rounds, safes and convertible notes, all these good issues. I want to start off with John.
Those are good questions. I'm not really sure I have great answers, but we do see, I see two things really. First of all, let me start with the easiest question, which is the second one. In terms of a convertible versus price round, and now we take whatever comes down the pike. We tend to still be a little bit. We're not greatly enthusiastic about the safe notes. We tend to think that they're a little bit too entrepreneur friendly, so we prefer convertible notes with different terms sometimes. But now it's 75% notes in terms of early seed rounds, as opposed to price rounds 10 years ago. There are very few groups that don't take convertible notes anymore. I think Life Science Angels may still not take convertible notes. Don't quote me on that, I may be wrong. But most of us, we had to go with the flow. In terms of what we see is we see higher valuations in Silicon Valley. I'm not sure I understand why. I see more and more companies coming, out of the woodwork. They have an MVP. They may have a little bit of traction. Instead of asking us for a $5 million cap, they come in and they want an $8-9 million cap. I'm not really sure I understand what's going on. And we see companies that are later stage, which is a different deal. That maybe VC type stage companies, but they come to us, with $14-15 million valuation. They're trying to raise from angel group for a variety of reasons. In terms of what we invest in, we don't have a theory. Everything that we think we can make money off. There's a lot of AI. There's starting to be some robotics, but for us, we're not experts in robotics, so it's still tough. But a lot of AI and ML and the usual stuff that you see coming down the pike. I think we're gonna see more and more robotics, but we're agnostic. And, as long as we think we're gonna make a lot of money, we'll invest in almost anything.
Thanks, John. Looks like a lot of companies do come out of incubators and stuff, and probably that's one of the reasons why these valuations seem to be higher, because incubators put some money in and they want sort of a step up when they go out there to seek money. That's probably one of the reasons, is what I heard. But Barbara, you come from a law background. Any your thoughts on deals and what kind of terms you like to see or what you're seeing?
Well, in general, the easiest to process are convertible notes, and it takes less paperwork, et cetera. So those are sort of the path of least resistance. So it's pretty easy.
Charles?
My strong preference is for an equity round. And for me, it's not the price so much as the terms. I come from New England, and there's an expression there, good fences make good neighbors. So even if it's a convertible note or even a safe, I mean, I don't like either of those, but I push very hard for determination and commitment to the terms of the eventual following equity round. And if I can't get that, it's an extra barrier. The deal has to be not only attractive, but super attractive or galactically super attractive for me to take one of these other deals. The second question is co-investing with funds. It's very common in my experience. The pre-money valuation is less of a criterion for me as what it can turn into. So, you know, our standard metric is we'd like a 10x return in 5 years. If that's feasible, or at least, you know, possible, likely, it doesn't matter if they're starting at 5 million or 50 million if the increase in valuation looks attractive. And what percentage of the deal I'm going to personally own is of less importance to me. I want the performance of my funds.
So I think we're running out of time, so I want to take some questions from the audience. But before that, let me see if you can quickly tell us what would you like to see in a startup. What are the key nuggets you'd like to see before you even consider an investment engagement cycle with them? What stands out to you?
Team, team, and team.
There you go. Next.
Team, and what's your angle? You know, how are you, you know, not 10% different to 10% better, but you're 3x, 5x better than the competition?
Okay, I'm going to differ or elaborate. For me, I want to address a significant problem in the world or opportunity. I want the deal to be a significant address or contribution to solving or capitalizing on that opportunity. Third, the team. Yes, it's critical. And fourth is the deal. And any one of those could be a deal breaker for me.
I think, thank you, panelists. They've done a great job in the short time you had in covering whatever we could, but we could take one or two questions. One question is what been told. Let's see who the winner is here. There's one question right there, the gentleman up there. Go ahead.
For me, it's part of the calculus that we have to solve. If it's going to take many rounds and many years, we have to have some idea of how that's going to take place. But for me, it all comes down to the IRR. You know, double return in a year or two, that's great. You know, 100-fold return in 10 years, that's also great. So it's the IRR that counts.
Yeah, I kind of think, you know, I'm sometimes involved in very deep due diligence analysis. I often do the financial analysis, so I do this all the time. Not all the time, but a lot, too often. So when I look, first of all, I think that as an investor, when I invest at seed stage, I think I should make 20 times my money, not 10 times. I used to think 10 times, and now I think that given the high risk it is, you know, I see the VCs, they don't invest because they know that it's too risky. They wait until there's $1 million ARR, right? You know, at $1 million ARR, I don't need 20 times, but when I invest, 20x is what I need. And so, you know, I look at, you know, the made up projections and whatever, and then I take into account the fact that there's going to be an A round or an A round and a B round and dilution. So I take, you know, I do some rough calculations. If I still show with credible numbers that I'm going to make 50x, you know, on paper, it never happens in real life, but, you know, on paper, you know, I feel more comfortable. But, you know, it's all educated guesswork. And you know, there are some deals where you know that they may need an A round or B round. They may want to raise an A round and a B round to go faster, and they will be able to. And there are some deals where you wonder if they're going to be able to raise an A round and B round. Those are very different deals, and you think about those very differently.
Great. Thank you. Thanks, Barbara. Thanks, John and Charles. Thanks for being a wonderful audience. Thank you very much.
Excellent. Thank you all for coming up. I want to thank you not just for speaking, but considering the immense importance of angel investors in the industry, thank you for doing what you do.